Welcome investors to another video here at FiscalVoyage. My name is Felix. Before we get started with today's stock analysis, I created a free ebook for you guys so that you guys could see some quick metrics that I look for before I spend hours researching each individual companies. So the free ebook is in the description. There's a link. Simply go to that link and download the free ebook. In this video, we're going to do a stock analysis on Intel Corporation. It was suggested by Marcel. Thank you, Marcel, for watching the previous video of mine and commenting and wanting me to do a stock analysis on Intel. If you're new to the channel, make sure to hit that subscribe button because I like to do stock analysis such as this video and talk about different financial and investment strategies. So make sure to hit that subscribe button if you're new to the channel. All right, Intel Corporation, ticker symbol INTC. I'm pretty sure you guys heard of this company, and I'm pretty sure you're using a device that has Intel products. The company is a multinational corporation, technology company, and is the world's largest and highest value semiconductor chip manufacturer based on revenue. Intel supplies microprocessors for a computer system manufacturers such as Apple, Lenovo, HP, and Dell. Intel also manufactures motherboard chipsets, network interface controllers, and integrated circuits, flash memory, graphics chips, embedded processors, and other devices related to communication and computing. So like I said, I'm pretty sure you guys have some device in your home or you're using right now that has Intel products in them. So let's go ahead with Intel's fundamentals. Revenue grew at a nice rate at 5.7% from 2010 to 2019. Net income grew at 6.9% from 2010 to 2019. So this is fairly modest revenue and net income growth. So it's positive here. S&P credit rating A+. So they have great credit rating, and we'll look at the balance sheet in a few slides. And this is one of the reasons why they have A+ credit ratings. Operating income for that 10-year period grew at 4.1%, and earnings had a nice double-digit growth at 10.1% in this 10-year period. And actually, for the past 5-year, earnings grew at 20.2%. So the past 5-year earnings has been tremendous. So that's one of the reasons why the price increased dramatically from a few years ago, from around $30 to where it is now. So that's very positive there. Revenue for the past 5 years grew at 6.8%, so slightly better than the 10-year average. And net income for the past 5 years at 16.5%, much better than the 10-year average. And most of these net income revenue growth came in from the increase in net margin. So let's go ahead and continue with the fundamentals. For 2019, the company earned $4.87 in adjusted earnings. Net margin came in at 29%, which was more in line with 2018, but much better than 2017, which only had 15% in net margin. So they increased net margin, which then increases earnings. That's why they had tremendous earnings growth that we saw for the past 5 years. Return on equity 5-year average is 21.2%. Currently, the company has a modest dividend yield at 2.2. So this dividend yield is nice. The 5-year dividend growth rate of 7% is respectable. So you're not getting high dividend yield and high growth. This is kind of more in line with that happy medium, that sweet spot area where it's kind of like 3% to 7% growth, 3% yield and 7% growth. But the current yield is only 2.2, but we're almost there. But I see them growing the dividend for numerous years because the dividend payout ratio is only 27.6%, so it's very low. So they have a lot of room to grow that dividend at a nice rate, and they've been growing dividend recently for the past 6 years with dividend growth. The charter rule came in at 9.2, which is the 5-year growth rate plus the current dividend yield. So we get 9.2. You like to see a company around 11 or 12 or higher with that charter rule points system. The 5-year yield average is 2.62. Currently, like you see here, 2.2. So the 5-year average is much higher than the current yield. So that might be an indicator that the company might be fairly valued to overvalued. But we'll look at that in a few slides from here. The most recent dividend increase came in January this year at 4.8%. So the recent dividend is lower than the 5-year average, and that trajectory has been for the past 3-year average, as well as the last 2 dividend increases. So that's something to look at, that why the company is lowering the dividend payments, even though they have big payout ratio, or a very good payout ratio of only 27.6%. Let's look at the balance sheet for Intel. Debt to cap at 31%, which is very good. Current ratio at 1.74, so this is better than the 1.5 you like to see of current asset divided by current liabilities. So that's a good current ratio. Debt to equity is real good at 0.52, and interest coverage of 54. So the likelihood of the company going bankrupt because they can't cover the interest is very unlikely. So that's very positive. This is why they have a A+ credit rating. Price to book is slightly higher than the 5-year average at 3.33 versus the 5-year average of 2.87. So this might be an indicator that it might be overvalued, but we'll look at that in a few slides. All right, let's look at the future outlook for Intel. 2020 analysts expect $4.82, where 2019 the company earned $4.87. So with the economic shutdown, they been hurting, most likely because sales of computer products and things like that may have dropped because everyone was at home. But it's not too bad as some other companies expected earnings for this year. But it is down versus the 2019 of $4.87. However, analysts expect earnings to pick right back up at $4.96 for 2021. So it's better than last year's earnings. So that's positive there. CFRA has projected compound annual growth rate for earnings at 7%. I don't see it at 7%. I kind of see it around 3 or 4%. But this is what CFRA suggests or is coming up with. My dividend drill return model projection total return at 9.9%. So this is beats my criteria of 9% or higher. So that's positive there, but not drastically as some of the companies that I've done before, where they have a projected total return of 12%, maybe even 13%. Forward PE at 12.5 versus the current PE of 12.4. Of course, this is because 2020 expected earnings to be lower than 2019, so this is why forward PE is slightly higher than current. However, it is lower than the 5-year average PE of 15.5, so this might be a good indicator that it may be undervalued, but we'll look at that shortly. The 20-year picture here, as you can see, earnings has been very erratic for Intel. There have been years where they've been growing earnings at a very nice rate in early 2000 at 57%, 43%. So that was nice earning growth. However, in 2006 until 2009, the company had earnings kind of flat in this time period. And something else to consider, this is what happens when you buy a company that's overvalued with high PE multiples versus their earnings. Say, for example, you bought it here at 24 PE. It basically took you almost, let's see how long, you could say right here, at 4%, almost what's that, almost 13 years before the company price actually took off. And this is because of overvaluation. This is why it's so important to buy companies that are either fairly valued or undervalued. Because you go years with very little total rate of return annually. Even though you still made money, $10,000 invested in 2001 would have been worth $16,000 at this time period. Most of it came from dividends because basically the price didn't increase too much from $20 to $27. You can see here. But most of the return came from dividends because the company was paying dividends and growing the dividends. But the price appreciation was very low. But once the company started to grow earnings at a consistent rate from 2014 to all the way to 2019, you can see that the price followed earnings. But if we do a 10-year period, because the 20-year period uses a higher growth rate, the last 10 years growth rate at 9.47, but analysts expect in the next 2 or 3 years growth rate to be around 3%, as you can see here. But based on this, the company looks to be fairly valued. It looks like it likes to follow the blue line. So I'm going to use a normal valuation of around 13. But you can see you have a potential annual rate of return of 7.5. But in the next slide, I'm going to provide you some fair value estimates from different analysts. But this is a modest rate of return. But I think you could do better elsewhere. So let's look at the fair value price for Intel. All right, so let's look at the fair value prices for Intel. CFRA has a fair price at $86.29. Morningstar at $70. FastGraph at $62.38. Yahoo at $62. And my dividend discount model analysis at $35.94. The reason why this is so low is because the dividend payout is low, and the next 3 years I don't expect a dividend increase of 7%, even though they've been increasing dividends much lower in recent years. But they have the room to grow it at 7% or more for the next 3 years, and I use this in 6 years after that with a discount rate of 10%. This is how I got $35.94. Averaging out to 5, we get a fair price of $63.58, and currently the company goes for $60.20. That means it's undervalued by 5.6%. However, I have a recommendation for Intel as a hold at current prices. So as you saw there, I have a hold recommendation for Intel, and the main reason I have a hold recommendation is just because of the valuation. Everything else, I love the company overall. The balance sheet is amazing, real good. The likelihood of being bankrupt or even the dividend cut is very unlikely because of the low payout, the high credit rating, the great balance sheet. So all of that is very plus. But the valuation is really what's my concern. Even though it's slightly undervalued, I'm pretty sure you can make money right now investing in Intel. It wouldn't be a bad buy if you were to start a position right now, maybe a very low percentage of your portfolio. But being it's not a screaming buy currently, you can make money. I think the company is going to continue to grow earnings, maybe not the next 2 years as analysts are expecting, but I think overall in the next 5-10 years, it's a chip manufacturer. Everything is going to be computerized and the Internet of Things, so they're going to continue making money. But right now, I think the price is slightly above what I would like to pay for. I would like to see a P around 10, maybe even 9 price to earning ratio. So if it was at that price to earning ratio, then I would see it as at a buy. But right now, that's why I have a hold. So thank you for watching. I really appreciate you guys for the support. We're almost at 1,000 subscribers. That's amazing. I didn't think I would get to this point right now. So thank you for watching. And if you're new to the channel, make sure you hit that subscribe button. And I'll see you guys in the next one. Best of luck.